Remember when I said to watch for debt restructuring and institutional validation before buying this stock? Well, it's happening right now. Welcome back to Smart Stock Sam, where we don't chase headlines or hype, we follow the smart money. While everyone's panicking about AMC hitting new lows, the world's biggest financial institutions just went on a massive buying spree, and they know something the market hasn't priced in yet. Today, we're breaking down why AMC might be setting up for an explosive move higher, driven by three things nobody's talking about: massive institutional buying that just got reported, a critical debt restructuring that changes everything, and a technical setup that historically precedes violent reversals. By the end of this video, you'll see exactly why the gap between where this stock is trading and where it should be trading is about to close, and it might happen faster than anyone expects. Let's dive in. Here's the disconnect that should immediately grab your attention. AMC is currently trading at $1.21 per share. Sounds cheap, right? But here's what the market is missing. This company is sitting on $1.75 billion in verified assets and property. That means you're effectively buying $1.75 worth of real, tangible assets for just 76 cents. When was the last time you saw a deal like that at your local store? This isn't some accounting trick or projected future value. We're talking about physical theaters, real estate, equipment, all valued at significantly more than the entire market capitalization. The market is pricing AMC like it's liquidating tomorrow, completely ignoring nearly $1 billion in verified value. When fundamental disconnects get this extreme, they don't stay disconnected for long. This past week was textbook market psychology, and if you know what to look for, it was screaming opportunity. Monday opened at $1.44, and we watched relentless selling pressure push the stock down day after day. By Thursday, we hit $1.21, a new low that had the bears celebrating and retail traders capitulating. But here's the critical detail everyone missed. The stock refused to break that floor. Friday's price action told us everything we needed to know. We saw a structural rejection of those lows, closing at $1.23 and ticking up to $1.25 in after-hours trading. That bottom wick on the weekly chart, that's not the beginning of more downside. That's exhaustion. The sellers threw everything they had at this stock, and it held. That's exactly the kind of price action that precedes reversals. Now let's put some real numbers on what you're actually buying at these levels. If you wanted to purchase every single share of AMC Entertainment today, the total cost would be somewhere between $630 million and $762 million. That's the market cap, the price tag for the entire company. Sounds expensive until you compare it to what you're getting: $1.75 billion in verified assets. The market is literally offering you a liquidation-level discount on a company that isn't liquidating. This is the definition of a margin of safety. Even if everything went wrong and the company had to sell assets, you'd still have massive downside protection at these prices. This is value investing meeting volatility, and opportunities like this don't come around often. While the bears keep repeating the narrative about dying theaters and streaming competition, the actual operational numbers are painting a completely different picture. AMC just reported $345 million in combined opening weekend impacts from major releases like Moana 2 and the upcoming Avatar: Fire and Ash. These aren't struggling box office numbers. We're talking about packed theaters generating real revenue in real time. The fundamentals are actually strengthening while the stock price is falling. Anyone who's studied market history knows what happens when you get this kind of divergence. The price eventually catches up to the fundamentals, not the other way around. The operational resilience is there, the revenue is flowing, and the market is completely ignoring it. Now here's the development that just destroyed the bankruptcy thesis overnight. On February 12, 2026, AMC announced a supplemental indenture amending the terms for its 2029 notes. If you're not familiar with debt markets, let me translate what this means. Management just secured the refinancing flexibility they desperately needed for their 2027 debt obligations. The bears have been betting on bankruptcy for months, pricing in a terminal value of 0. That bet just got significantly riskier for them. The bankruptcy clock didn't just pause, it got extended with meaningful runway. This single announcement changes the entire risk profile of this investment. If you think I'm the only one seeing this opportunity, you haven't looked at what the institutional money is doing. While retail traders were panic selling at the $1.21 bottom last week, the biggest names in global finance were aggressively accumulating shares. JPMorgan Chase increased their position by 87.64%, adding over 3 million shares. Think about that for a second. JPMorgan doesn't deploy capital carelessly. BlackRock, the largest asset manager in the world, increased their holdings by 19.39%, bringing their total position to over 40 million shares. UBS jumped in with a 36.64% increase. These aren't retail meme traders gambling on Reddit posts. These are institutional giants with teams of analysts, sophisticated risk models, and billions of dollars in assets under management. What are their algorithms seeing that the market is completely missing? Even the analyst community, which has been bearish on AMC for years, can't ignore the mathematics anymore. The average Wall Street price target sits between $2.31 and $2.58 from the current $1.25 level that represents immediate 100% upside, and that's with a conservative hold rating. If we look at the more bullish targets from firms like Wedbush, we're talking about $4.50. Historical models that factor in normalized valuations suggest a path back to $10 isn't off the table if the operational momentum continues. The gap between current price and fair value is massive, and history shows us that gaps this wide don't stay open indefinitely. But here's where the setup gets truly explosive. The short interest situation is reaching a critical inflection point. 24.22% of the float is sold short, representing roughly 125 million shares that need to be bought back eventually. Now here's the part that should make every short seller nervous. There are currently 0 shares available to borrow. 0. The cost to borrow is spiking, liquidity is drying up, and the short sellers are running out of ammunition. When you combine high short interest with no available shares to borrow and rising costs, you're building a powder keg. All it takes is one catalyst, one spark of buying volume, and those 125 million shares have to cover. What happens to the price when 125 million shares try to buy in a market with 0 liquidity? Let's look at what the technical indicators are screaming right now. The relative strength index is sitting at 31, deep in oversold territory. Every single time AMC's RSI has touched the 30 level historically, we've seen violent upward corrections within days, sometimes within hours. This isn't speculation or hopeful thinking. This is statistical pattern recognition based on years of price data. The selling pressure has reached a mathematical point of exhaustion. There simply aren't enough sellers left to push this lower. The technical setup is primed for a reversal. The pattern that has me most excited for next week is this falling wedge formation developing on the daily chart. This is one of the most reliable bullish reversal patterns in technical analysis. The price gets compressed between 2 converging trend lines that are both sloping downward, and as the pattern matures, it typically resolves with an explosive breakout to the upside. We're at the apex of that wedge right now, heading into the week of February 17th. The compression is at its maximum point. The spring is coiled as tight as it's going to get, and the historical resolution of this pattern is overwhelmingly bullish. Now we need to talk about the options market because this is where things could accelerate exponentially. For the February 20th expiration, there's massive gamma exposure building at the $1.50 and $2 strike prices. We're talking about over 65,000 combined call option contracts. Here's why this matters and why it creates a feedback loop. If the stock price breaks above $1.30, the market makers who sold those calls are forced to buy shares to hedge their exposure. That buying pressure pushes the price higher, which triggers more hedging, which creates more buying pressure. It's a self-reinforcing cycle that can pull the stock price toward those strike levels like a magnet. Once it starts, it can move fast. What we're witnessing right now is a textbook bear trap forming in real time. You've got artificial downward pressure from the $150 million dilution program and debt-to-equity conversions creating a ceiling on the price. But that ceiling is now colliding with a rock-solid floor built by massive institutional accumulation. These two forces are compressing the stock into a tighter and tighter range. The moment that dilution program completes and the ceiling lifts, the institutional floor is going to force this price higher. The coil effect is intensifying every single day, and the release of that pressure could be violent. Before we wrap this up, I need to be crystal clear about something. This content is for educational and informational purposes only. I am not a licensed financial advisor, and nothing in this video should be construed as personalized financial advice or a recommendation to buy or sell any security. Trading stocks, particularly volatile stocks like AMC, carries substantial risk, and you could lose your entire investment or more. You must do your own due diligence, understand your personal risk tolerance, and never invest money you cannot afford to lose entirely. Past performance is not indicative of future results, and all investments carry risk. So, how do we actually position for this setup? For the week of February 17th, I'm watching $1.30 as the critical trigger level. A confirmed hold above $1.30 with accompanying volume would be our entry signal. The first target is $1.35, which represents immediate resistance from recent price action. But the real prize is target 2 at $2, which would fill the entire recent gap and validate this entire thesis. I'm using $1.21 as the hard stop loss, that floor we just tested and held. If we see a volume spike as the stock breaks through $1.30, that's our confirmation that those 124 million short shares are beginning to cover, and once that starts, it feeds on itself. Here's the bottom line that ties everything together. The disconnect between a $1.21 stock price and $1.75 billion in verified assets is fundamentally unsustainable. With major institutions accumulating at these exact levels, bankruptcy risk significantly reduced through debt restructuring, and technical indicators all aligned for a breakout, the setup strongly favors a violent reversion toward fair value. AMC isn't just a meme stock anymore. This is a calculated, data-driven opportunity with clear catalysts, defined entry and exit points, and measurable risk parameters. The real question isn't if this gap closes, it's how fast it happens when the dominoes start falling and those short positions begin to cover. Stay disciplined, watch those key levels, manage your risk, and I'll see you in the next one. This is Smart Stock Sam, reminding you to always trade smart, not hard.